Hi there. Thanks for tuning in. Today we're going to do a update on Atcore Inc. So I analyzed them in 2023, right around when they had released quarter three earnings. Now they've released quarter two 2024 earnings, and we're going to just do an update on it. This is in light of a comment by Clisthenes607. Will you be doing an update in light of their crashing stock price? I said absolutely, so I'm doing this. And well, the word crashing is a little bit strong here. I mean, year to date, it's dropped 16%, which I wouldn't consider crashing. Crashing would be a 50% drop, in which case I'd be like, this is kind of a screaming buy. But 16%, I think, is pretty normal. If it was trading close to 200 and that just wasn't in line with what the actual cash flow numbers were, well, then I wouldn't be too surprised that things actually went downwards. And we're going to explain a little bit as to why. One of the things is that they had good results in quarter two 2024, but at the same time, their net sales are down, their net income is down, their EBITDA is down, etc. So everything is down. However, what they're saying is that it is in line and sometimes exceeding their previous outlook for 2024. And so this is something that they're adjusting, but they did say at the end of their 2023 annual report, they said our revenue and our sales are probably going to be down compared to this last year. So just prepare for that. And yes, their stuff is all down by double digits compared to quarter two 2023. This shouldn't come as a shock because they had been telling us. And even though if you look at this quarter two income statement, everything looks terrible. Double digit negatives over here all across the board. I mean, that's just horrible, right? Well, I think while that is true, although they're paying a little bit less tax, so that benefits their bottom line a little better, they do have a lot going for them. So here, for example, you can see what they did with cash flow from operations minus capital expenditures, and then they're repurchasing $156 million worth of stock, and then another $12 million in a small dividend payment. That's something they didn't really have before. So they are still deploying all that cash from operations that they have. They still love to deploy that to buy back shares because they find that the company is undervalued. And looking at also their debt maturity profile, they don't really need to pay off a lot of debt until way later, and their debt is well covered for the most part. So we don't have to worry about this for a while at least. Now, their forward year 2024 outlook, it had been in this 3.3 billion to 3.5 billion of net sales so far. They've amended things a little bit, just changed a little bit of this range, but at the same time, this shouldn't surprise us too much. And they're still telling you that they're going to do over 250 million worth of stock repurchases. So the diluted shares outstanding is going to be in the 36 to 37 million range. Right now it's in the 37.6 million ish roughly. So Atkore is still, despite earnings being down, actually giving money back to the shareholders. And they're telling you very clearly to expect this kind of stuff. So, my last discounted cash flow model, it was basically accounting for some of this. Notice that in the 2023 and 24 estimates, I had free cash flow going down compared to 2022. And then in 2025-26, I had it finally recovering. So this wasn't a huge shock to the system to me because I already had an an estimation that was basically assuming that things were going to go down. Now, my previous value was $147.53 after that debt, and now let's do an updated one with the latest full year 2023 data with updated forecasts based on the lower end of their guidance to be conservative and a 16% free cash flow to revenue margin. Essentially, 16% of the revenue gets turned to free cash flow. They've done a little better than that, but let's just say 16% to be conservative. Now, this current model gives us $148.12. So honestly, it's just not that different. It's the difference of maybe 60 cents, 70 cents here more. And the reason why, it's crazy because you could be asking me, David, if the earnings went down, if the free cash flow went down, and actually your estimates here have these numbers being lower than what they originally were, what's going on here? Well, the big reason why is notice this shares out number from 37.8 million to 36.4 million. So it's going to be very different now. They have bought back those shares. They have actually returned value. If you're an owner, it's worth more and more to own this company since they're buying back those shares, and their net debt hasn't changed. Their earnings look okay because I had already forecasted that they were going to go down in earnings. They actually outperformed in 2023, and I'm just still being conservative in 2024. I feel like that doesn't change the outlook hugely with this 11% expected rate of return and 2% perpetual growth rate that I'm assigning to them. It just doesn't change anything too significantly. And if you look at the long term, well, yeah, this is a blip in price, but I wouldn't call it a crash going from this 200 level to 136.89 US dollars. I mean, this is still below this number of $148.12. So I wouldn't really be panicking because the stock price went lower. I mean, if you bought at 200, yeah, I'm sorry. It just wasn't going to be based on the numbers. But if you are looking at it right now, it still looks potentially interesting. This is a conservative estimate too. So I think it still looks like a very interesting stock. And with the dividend yield, with the share buybacks, you're generating value, which is why they can maintain a great price, at least in my model, compared to the earnings that are a little lower this year. So let's talk about what actually creates the value here. So buying back shares has meant that value is being created even with lower earnings, and especially if they can buy those shares at a critical juncture, that's showing that they have confidence that the company is undervalued. And if for some reason they can buy it under book value, then that's actually creating even more book value. And that small dividend yield also shows confidence that they're going to have free cash flow. They show that, yeah, we'll be able to pay you back all the time. This is where conservative estimates also matter, as I was saying, or adding a margin of safety if you do an estimate that is more along the midpoint or the higher end. So that makes up the difference. My numbers already factored slightly less free cash flow for the next year. So I wasn't too shocked. My valuation didn't change too much because I was already expecting it. And just ask yourself if you're in it for the long haul or not. If you're in it for the long haul, movements like this minus 16%, shouldn't really scare you because if you're saying, hey, Atcore in the long run is going to grow earnings, sure, modestly, but they're going to deploy that cash to give it back to me. At the end of the day, your value is going to compound. That's something that if you want to be an owner of Atcore, be ready to be in it for the long run. I mean, sure, there could be a movement like this one that just brought it from maybe this 120 level to close to 200, but don't go in just expecting that. Go in just saying, hey, this is fundamentally great. This is something that I wouldn't mind owning for the long term. They're going to buy back shares in the long term, give me that dividend. It's going to compound over time. And then eventually people will realize its true value. That's why I would go in it, at least for the long run. And that's why I wouldn't be shocked by those short term movements. Now, with that said, I just pose this. So keep focusing on what actually generates value. Remember why you're actually buying it, and then let's see if it still fits your portfolio. Does it still fit my portfolio if it were $250? Probably not, because I want companies that are fundamentally undervalued compared to the cash flow that they generate. Atcore wouldn't do that at $250. Would it do that at $100? Absolutely, it would. So you just have to see at those junctures if it still fits your philosophy. If it's a company that you think is going to still compound, if you're still buying back shares how you like it, if they're buying back enough, of course, or if they're diluting you. You just have to see how that goes. Now, hope you got a lot out of this video. I was happy to do this update, and if you want to see more like this content, feel free to comment down below and let me know what you want to see. Thank you so much for watching, and I hope you have a fantastic rest of your day.